Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today, we're looking at GameStop.
If you find our talks useful, please consider subscribe, like, and comment underneath. So today, you are looking at a struggling mall retailer that is secretly sitting on a bigger cash pile than a lot of mid-sized corporations.
Yeah, it's really something.
We are bypassing the old internet message board headlines completely here. You aren't evaluating a company that sells physical video games anymore, you know?
Definitely not. You are evaluating a $9 billion bank account that's just, well, waiting to deploy capital.
Right.
Which turns us into a really fascinating asymmetric bet. And for you listening, an asymmetric bet simply means the potential upside in this scenario is just exponentially larger than the downside risk.
Exactly.
We're tracking a very specific event-driven swing trade here with a horizon of roughly 1 to 6 months. Management has built this massive war chest.
Massive is almost an understatement.
Yeah, I mean, the entire business identity is undergoing a fundamental shift from traditional retail operations to more of a holding company structure.
Okay, let's unpack this. Because if you are still looking at this stock through the lens of, like, foot traffic at your local shopping mall,
The picture looks pretty bleak.
it looks terrible. Recent data shows annual revenue has dropped to $3.63 billion. And for most traditional Wall Street analysts, top-line contraction is the beginning and the end of the story.
So absolutely, they see revenue dropping by double digits, assume the business model is dead, and just write the whole thing off.
It's like you just look at the top line. It looked like a dying plant.
Yeah.
But is management actually just pruning the dead branches to save the tree?
That is a great analogy. Because the top-line contraction is undeniable, sure, but viewing it as a failure really misses the underlying strategy. Management is aggressively executing this shrink-to-grow mandate.
Shrink to grow, okay.
Yeah, over the last few years, they have slashed their United States store footprint by more than half.
Wow, half.
More than half. And they completely exited several international markets. So when a company purposefully closes hundreds of its own storefronts, overall revenue is mathematically guaranteed to fall.
Right, you can't make money in a store that doesn't exist. It's similar to managing a massive commercial real estate portfolio, I guess.
How do you mean?
Well, imagine you own 500 strip malls, but 200 of them require more money in maintenance, staffing, and taxes than they actually generate in rent.
Right, they're cash flow negative.
Exactly. If you sell off those 200 underperforming properties, your total gross revenue drops significantly. But suddenly your profit margins look incredible because you've stopped the cash bleed.
You're actually keeping the money your good properties make.
Yes.
And that's exactly what's happening here. The focus is ruthless capital preservation. By shedding those expensive retail leases, cutting the localized staffing overhead, and eliminating the logistics costs of shipping inventory to unprofitable geographies.
They're stopping the bleeding.
Exactly. They are pivoting away from the traditional pure-play retail model entirely. The margin outlook strengthens considerably when you aren't subsidizing failing locations.
Makes total sense.
This isn't passive retail decay. It is a highly orchestrated defensive retreat designed to protect their balance sheet.
So we have a company actively shrinking its physical footprint to stop losing money. The obvious question you have to ask is, what are they protecting?
Right.
Like, if they're preserving all this capital by closing stores, exactly how much money do they have and where is it?
Well, the current balance sheet is arguably the most robust in the entire specialty retail sector right now.
Yeah, really, the most robust.
Hands down, they are sitting on $9.01 billion in combined cash and short-term investments.
$9 billion. Let that sink in for a second.
It is a staggering amount of liquidity for a company of this size. And to understand how they built that hoard, you really have to look at how masterfully management navigated the market volatility of the past few years.
Because they certainly didn't make $9 billion selling used gaming consoles, right?
Definitely not. No, they engineered it through highly strategic equity raises.
Okay, walk us through that.
So during periods of intense market enthusiasm, when the stock price was surging based on retail investor sentiment rather than fundamentals.
The meme stock craze.
Exactly. During those peaks, management executed what are known as at-the-market offerings. They issued new shares directly into that buying frenzy.
Very smart.
Extremely. And they paired that with a $4.16 billion convertible debt issuance.
Okay, wow.
By doing this, they effectively captured that fleeting, volatile market sentiment and locked it down into permanent, cold, hard cash on their balance sheet.
See, here's where it gets really interesting for your wealth building strategy. Because holding $9 billion in cash transforms the entire nature of the stock.
It absolutely does.
It effectively makes them a pseudo-SPAC.
Right, a special purpose acquisition company.
Exactly. A SPAC is just a giant pool of money raised by investors with the sole purpose of going out and buying a real operational business. They aren't a store anymore. They are a bank account waiting to buy something.
A bank account that fundamentally de-risks their operational transition? Yeah. I mean, they don't need to approach a traditional bank for loans.
Right.
They don't have to worry about high interest rates limiting their turnaround efforts. They have the capital on hand to completely reinvent the company overnight.
Which is an incredible position to be in.
It is. And how they're managing that treasury is equally unprecedented.
Yeah.
Filings show the company actually retains 4,710 Bitcoin.
Wait. Bitcoin.
Yeah, which as of January 31st, 2026 is valued at approximately $368.4 million.
Okay, let's pause there, because a traditional board of directors at a legacy retailer does not typically approve holding hundreds of millions of dollars in highly volatile cryptocurrency.
No, they usually park their excess cash in ultra-safe treasury bills.
Right. So what is the underlying mechanism here? Why hold Bitcoin?
Well, it serves two distinct purposes. First, it diversifies their treasury away from strictly fiat currency and traditional short-term paper, giving them an asset with massive, uncorrelated growth potential.
Okay.
But more importantly, it is a cultural signal. This management team understands that their most valuable asset isn't their physical stores, it's their investor base.
Oh, that makes so much sense.
Right. They have this cult-like retail following. By adopting a HODL mentality, basically refusing to sell their crypto assets, they align themselves perfectly with the ethos of their most passionate shareholders.
Which completely redefines the concept of a competitive moat.
Yes.
Usually you think of a company's moat as like a proprietary technology, a patent, or an unbeatable supply chain. But you were describing a moat built on internet culture.
Internet culture and unprecedented retail loyalty. We classify this new moat as financial optionality and brand equity.
Financial optionality and brand equity.
Got it. The financial optionality is obvious. $9 billion allows them to buy cash-flowing assets that instantly replace their declining retail revenue.
Right, the SPAC idea.
Exactly. The brand equity, however, is unique. That passionate retail following provides them with access to capital on incredibly favorable terms.
Meaning they could always just ask their investors for more money.
Precisely.
Yeah.
If they ever needed to raise more capital, they have an army of retail investors ready to absorb new shares. Traditional valuation models are simply not equipped to price in that kind of frictionless capital access.
Yeah, that breaks the traditional models entirely. But with that $9 billion just sitting there, the speculative catalysts are driving the entire narrative now.
Oh, for sure.
I mean, CEO Ryan Cohen has been highly vocal, publicly teasing that a very, very, very big transformational acquisition is currently in the works.
Yes, he has.
And the market is desperately trying to figure out where that money is going to be deployed.
The rumors are generating immense volatility right now. You are seeing massive names thrown around in analyst circles.
Like who?
Well, is the target Best Buy? Could it be a connected fitness play like Peloton?
Best Buy and Peloton, okay.
Right, and while these are totally unconfirmed, we have to look at the underlying logic of why the market is floating these specific targets.
Because it reveals what Wall Street thinks management is actually trying to build.
Exactly.
So let's look at Best Buy first. Buying a giant electronics retailer would essentially consolidate the entire specialty electronics market under one umbrella.
Which would be massive.
They could leverage Best Buy's Geek Squad service model and integrate gaming hardware, PC building, and tech support into this massive unified retail network.
Yeah, it makes strategic sense. And the Peloton rumor represents a totally different strategic direction.
Oh, so?
That would be a pivot into hardware as a service. Instead of relying on, one-off sales of physical game discs, they'd be acquiring a company built on recurring, high-margin monthly subscriptions.
Oh, wow. Okay.
But honestly, whether either of these specific deals happens is almost secondary to the market's current behavior. These rumors alone are triggering algorithmic flows.
And for you listening, algorithmic flows are simply computer programs on Wall Street that scan the news and automatically buy or sell millions of shares based on positive or negative sentiment.
Exactly. They react in milliseconds.
So when rumors of a multi-billion-dollar acquisition start flying around, these algorithms buy in, creating upward momentum. The market isn't pricing in the declining mall stores anymore.
No, they're looking past that.
They're increasingly pricing in a major transformational transaction.
The narrative has shifted decisively from a failing retailer to a conglomerate in waiting.
Wait, hold on. Let's look at the actual risk here, because buying another company sounds fantastic in a press release, but integration is notoriously difficult.
It's the hardest part of any M&A deal.
Right. So if they buy Best Buy, aren't they just taking their beautiful $9 billion cash pile and setting it on fire in a different mall? I mean, Best Buy is facing the exact same macroeconomic retail headwinds. And if they buy Peloton, they are buying a company that has famously struggled to maintain its growth post-pandemic.
If we connect this to the bigger picture, this is the execution risk. And it is the absolute core of the bear case against the stock.
The bear case being that they screw up the acquisition.
Precisely. The entire bullish thesis relies on management executing an accretive acquisition.
Accretive?
Yes. In finance, accretive simply means the new business brings in more value and cash flow than the cost to acquire and run it.
Okay, simple enough.
If management overpays for a declining asset, or buys a company with a massive debt load, they will burn through that $9 billion rapidly without securing a viable engine for future growth.
And you have to add that to the fact that their legacy business is still shrinking. Revenue is falling double digits. If this transformational acquisition takes 2 or 3 years to materialize, the operational costs of running their remaining stores could slowly drain the war chest.
It sounds like a ticking clock, right?
Exactly. It sounds like a ticking clock.
Yeah.
So where is the safety net for an investor jumping into this trade?
The safety net is hidden in the mathematics of their balance sheet. This brings us to the concept of the margin of safety, which creates a massive floor for the stock price.
Okay, let's hear the math.
We have to run the numbers on the absolute worst-case scenario for their core operations. Let's assume the physical retail business continues to bleed, burning somewhere between $200 million and $300 million annually in operational losses.
Seeing $300 million go out the door every single year sounds catastrophic for a turnaround play.
It would be, if they didn't have the cash pile.
Ah.
But look at the interest income. They have $9 billion sitting in short-term investments and cash equivalents. Even in a really conservative environment, let's assume that capital generates a 4.5% yield.
Okay, 4.5% on $9 billion.
Generating 4.5% on $9 billion equates to roughly $400 million a year in pure interest income.
Wait, the math there is wild.
It's crazy, right?
The interest they generate just for having the money in the bank is $400 million, and the absolute worst-case loss from running the failing stores is $300 million.
Exactly. The interest income completely covers the operational cash burn, with $100 million left over.
Oh, wow. So they aren't even touching the principal.
They are not actually touching their principal. Management has bought themselves years, potentially decades of runway.
That's incredible.
They do not have to rush into a bad acquisition just to appease Wall Street because the cash pile is literally paying for the decay of the retail footprint.
It is the ultimate margin of safety.
Yeah.
It's the equivalent of a trust fund kid whose massive inheritance generates enough monthly interest to cover the losses of their failing startup business indefinitely.
That's a perfect way to look at it.
The underlying principal never shrinks. That completely alters the risk profile for you as an investor. The floor is incredibly solid.
Yeah, it really is.
So, with that safety net in place, how is the market pricing this right now? Let's get into the actionable timelines and technical setups over the next 3 months.
Sure. So the stock is currently trading around $22.20. It has experienced some recent pressure, down about 8% over the past month, but it is still maintaining a 7.2% gain year to date.
Okay.
From a technical analysis standpoint, the chart is in a coiling phase.
Coiling, like a spring.
Exactly like a spring. The price is consolidating, finding strong support levels, and winding up tightly as it waits for a fundamental catalyst to push it through resistance.
And independent analysis seems to agree with that floor. Seeking Alpha recently published a fair value estimate of $23.14.
Right.
But the critical thing to understand about that valuation is that it primarily prices in the cash floor we just outlined. It completely ignores what analysts call the blue sky upside.
And blue sky upside represents the absolute best case scenario. The potential explosive growth if everything goes perfectly according to management's plan.
Right.
That $23 valuation is pricing the company as a bank account with a failing retail attachment. It places zero value on the conglomerate in waiting.
Which means we are basically just waiting for specific events to force the market to price in that blue sky potential.
Yes.
So what does the catalyst calendar look like for the upcoming quarter?
Well, the number one catalyst is the imminent M&A announcement. We know a large deal has been telegraphed.
The very, very, very big one.
Exactly. When the formal announcement drops, revealing the target, it has the potential to trigger a massive multiple re-rating for the stock.
And for you listening, a multiple is just how much Wall Street is willing to pay for every dollar of a company's earnings.
Right.
A declining mall retailer might trade at a very low multiple, say 1x its revenue,
Yeah.
but a tech-forward holding company or a digital subscription business trades at a much higher multiple, maybe 5 or 10x its revenue.
Exactly. Changing the identity of the company mathematically forces the stock price higher.
Yep.
The moment the market knows exactly what that $9 billion bought, the stock is no longer evaluated as a video game store. But before that major announcement drops, we have a second catalyst, the Q1 fiscal year 2026 earnings report.
Okay. And this requires a specific wealth-building approach to analyze properly, right?
It does. When those numbers cross your screen, you need to completely ignore the headline earnings per share or EPS.
Wait, really? That feels counterintuitive. Usually EPS is the only thing the financial news networks talk about on earnings day. Why ignore it here?
Because traditional EPS will not give you an accurate picture of their financial health during this specific transition phase. EPS blends everything together.
Okay, so what should we look at instead?
You need to isolate two specific metrics: cash burn versus investment income.
Going back to the trust fund math.
Exactly. You are simply verifying that the interest being generated by the $9 billion is still actively offsetting the operational losses from the ongoing store closures.
Makes sense.
As long as that specific mathematical equation holds true, the margin of safety remains perfectly intact.
So ignore the headline noise, focus exclusively on the yield versus the burn. If the interest covers the losses, the trust fund is still intact.
Precisely. And there is a third, highly unique catalyst on the calendar. We cannot forget the Bitcoin holding.
Right, the 4,710 Bitcoin.
Yes, that acts as a built-in uncorrelated asset boost. Every time the broader crypto market goes on a massive run, the underlying book value of the company automatically increases.
Without them doing a thing.
Exactly. They don't have to sell a single piece of inventory or close a single store to see their balance sheet strengthen. It guarantees that the stock will experience price swings tied to crypto volatility, regardless of their retail performance.
That is just wild.
It's a completely unique setup.
So what does this all mean for your portfolio? Let's bring the entire strategy together.
Let's do it.
Looking at this strictly through a wealth-building lens, this setup earns a 7 out of 10 bullish score. Yes, it carries high uncertainty. Execution risk is a real threat, and nobody knows exactly what target management is going to acquire.
Sure.
But the structure of the trade offers a massive asymmetric upside. You have a highly quantifiable cashback floor protecting your downside, funded by hundreds of millions in interest income.
Yep. Safety net is there.
And you have an explosive blue sky upside scenario waiting on the announcement of a transformational acquisition.
The timeline for this event-driven swing trade is roughly 1 to 6 months. The strategic play is establishing a position before the formal deployment of the capital.
Because once the news drops, it's too late.
Exactly. Because the moment the news breaks that the war chest has been opened, the market's perception will alter instantly and the stock will re-rate. It is a phenomenal case study in corporate evolution.
It really is.
And I'll leave you with a final lingering question to mull over as this plays out. When a legacy company completely abandons its traditional business model to become a holding company, one fueled almost entirely by internet culture, passionate retail loyalty, and billions in raised cash, do our traditional Wall Street valuation models even apply anymore? Or are you witnessing the birth of an entirely new kind of market entity?
That is the billion-dollar question, literally. Well, thank you for joining this session of Smart Wealth with Joshua.
Always a pleasure.
Keep a very close eye on that upcoming earnings report. Focus strictly on the cash yield versus the burn, and we will be right here to analyze the fallout when that war chest is finally unleashed. Keep building, keep learning, and keep looking past the headlines.